With the 8.6% inflation rate, market crashes, and cryptos losing value, bonds are becoming more attractive. They are known to be safer. I-bonds are savings bonds that pay a fixed interest rate plus a semi-annual adjustment key to the consumer price index. That means the interest rates are adjusted every 6 months to keep pace with the rising prices. As a result, your money isn't losing its value. Maximum purchase per calendar year is $10,000 per person and $20,000 for a couple. I-bonds earn interest monthly, though you don't get access to the interest payments until you cash out the bond. Interest you earn is added to the value of the bond twice per year. This means the principal amount you earn interest on increases every 6 months, positioning your money to compound over time. At maturity in 30 years, the bond ceases to accrue interest. Interest on I-bonds, as on all U.S. government debt, is exempt from the state income tax. Now, the important question, how much will you earn? The initial interest rate on a new Series I savings bond is 9.62%. You can buy I-bonds at that rate through October 2022. The inflation adjustment changes every 6 months and now generates an annualized 9.62%. That is, if you put in $10,000 now, you'll be credited with $481 of interest for your first half of the year. Yes, $481. I know that in an era of close to zero savings account interest, a $481 semi-annual coupon doesn't sound bad, but earning $481 after 6 months for a $10,000 investment isn't fair by a stretch, especially because you will eventually owe income tax on your putative interest. Allow for that tax, and you will find your real return is negative. Let us assume that you are in a 24% bracket. Your principal balance is $10,000 and inflation is 10%. After a year, you will have a balance of $11,000 but owe $240 in tax to be paid now or later. The $10,760 that belongs to you buys less than $10,000 did with the year before. Unless that, of course, you use that for education, then it's tax-free. Understand what is going on. The government is running a deficit. It covers that in part by printing money to hand out and in part by borrowing from savers. The savers are made poorer with each passing year, a consequence of the fact that the borrower, the inflator, and the tax collector are all the same entity. Now, does that make I-bonds a bad investment? No, it just means that you need to know its place in your portfolio. It's a place to park your cash and keep it safe. I-bonds are backed by the federal government. I hope that helped. And if you have any questions, please let us know in the comments section below. This has been Natalie Denise for Noble Gold Investments.